This is Barry Knapp from Ironsides Macroeconomics. I'm recording this on Sunday, December 19th. You'll be listening or viewing it on Monday, December 20th, most likely. Merry Christmas and happy holidays to everyone. This week, we wrote the last of our three outlook notes. The way we've done this for years is we provide a typical next year outlook note. That one was titled Inflation Policy and Politics. And 2 weeks later, of course, inflation policy has looked like it's led to the collapse of the Build Back Better legislation from the Biden administration. We'll come back to that in a minute. Our second report was more of a thematic investing note. We titled it Macro Themes for the 20s Cycle. And then this week, we wrote a 2021 year in review note. That's a practice we started all the way back in our Barclays equity strategy days. It's always interesting for us to go back through and look at what we got right, what we got wrong, what we think really happened in the prior year and what it means for the next year. Of course, our brand is it's never different this time. So if you don't go back and think about the prior year, it's hard to have perspective on the subsequent year. Now, as we're writing this, S&Ps are down about 23 handles. S&Ps, NASDAQ, and the Dow are down similar amounts. So it's not clear to us whether this is a follow through from the sell-off post the Fed meeting. Obviously not on the day of the Fed meeting. We had a ferocious rally, but then the market started to fade after that on concerns about tighter monetary policy. It could also be some concern about the collapse of the Build Back Better plan. If so, that's a fairly ridiculous reason for the market to sell off. Quite frankly, this is very good news for corporate profits and our capital investment thesis. One of our major concerns throughout the course of 2021 was that the Biden tax plan would roll back the Tax Cuts and Jobs Act and make the U.S. a less desirable destination for foreign capital to really rebuild our manufacturing base. So we're actually quite pleased that Build Back Better has collapsed from the perspective of an equity investor, not from any other political perspective, but just from that perspective. And it does actually increase the possibility or probability that we have a rally in January like we did in 2018 after the Tax Cuts and Jobs Act was passed on the basis of what it meant for corporate earnings. I suspect a number of strategists may have to bump their numbers up for next year because we won't have these punitive increases in international corporate tax provisions. So it's on balance actually pretty good news. Bond yields are a little lower, but the sell-off is all in the belly of the curve, which makes us think, some of the selling or the majority of the selling is related to that tighter Fed policy. And then crude's down $1.50 or so. So it does look like a general risk-off environment. We would note one of the things we wrote a note about as a Fed preview last week was this idea that the sequencing of Fed policy might change somewhat. And Governor Waller gave a speech on Friday afternoon, and then in the Q&A talked about wanting to start the balance sheet contraction as soon as 1 to 2 meetings after they ended asset purchases. That would be a change in their process that would lead to a steeper curve, would raise longer term rates, potentially cool off the housing market. We think there's a very compelling case for them getting started on balance sheet contraction much sooner than they did last go around. But we'll leave that issue aside. We're going to get to the 2021 year in review, but we're going to keep our comments on this podcast and video fairly succinct, primarily because we put the note outside the paywall. And our reason for doing that is to give the free subscribers to our research a chance to see what our research is all about, hopefully with the idea that they'll subscribe for all of our hopeful wisdom in 2022. But you can go out and read the note yourself. So here's my summary of what we talked about. We wrote the first section we titled Growth, Prices, and Earnings, and that was a bit of a review of the economic comings and goings in 2021. The next section was the third tailwind. That was all about inflation because our outlook for 2021 had been 3 tailwinds and policy risks. Those tailwinds were a very robust recovery in global trade and manufacturing from the trade war and the pandemic. The same thing, the second tailwind was a strong rebound in capital investment from the trade war and the pandemic. The first trend we thought would last for the first half to 2/3 or so of the year and then would start to fade. It actually persisted throughout the entire year. The second tailwind was a strong capital investment recovery that we thought would be a secular boom, with our only risk to that being the Biden tax plan, which now looks like it already had been watered down, but now looks like it may very well be dead. And then the third tailwind was reflation. And with all those policy risks, right? Higher taxes, as well as the Fed starting to respond to that reflationary risk. So if you go back, and then we went on to talk about policymakers partying like it's 1965, our 60s analog. And then finally, stocks are rich, but bonds are richer, which is our summary of what we think happened in the markets and a little bit of a mark to market on valuation. So going back to this growth and earnings dynamic, as I said, the trade recovery lasted longer than we expected it to, in part because of zero COVID policies in Asia. They kept locking down things and making the supply chains problems worse. We did the same thing in this country with extending the unemployment benefits all the way out to September. Remember, when we originally wrote those notes a year ago, we thought we were going to have a split government, that the Republicans were going to hold the Senate and they wouldn't be able to extend those benefits that long. So that to us was part of the issue. But on balance, those first two tailwinds came through as we expected. And one of the ways we tried to articulate just how far off consensus was and policymakers were on the outlook was we took the summary of economic projections from the Fed's December 2020 meeting, and then again last week's meeting in December of 2021. So if you look at what was expected for 2021 GDP, they were talking about 4.2%. Now it looks like it'll be more like 5.5. They thought the unemployment rate would be 5%. It's going to come in. It's at 4.2. For some reason, the SEP had a 4.3 number in there. I don't know why they all think it's going to tick up next month. I'm pretty dubious on that. And then, but the real miss was in inflation. The Fed had inflation not reaching their 2% target throughout the entire forecast period. Of course, it blew through that. It's coming in at 5.3% was their expectation for this year and 2.6 for next. We think that 2.6 number for next year is too low. We're hopeful that it'll settle in below 4, but we think it'll likely be above 3. So that just underscores how far consensus was off the mark. And of course, we didn't put a specific number on it, but we wrote about inflation in almost every report throughout the entire year. And reflation and a big inflationary surge was integral to our forecast for 2021. So then there's a couple of other interesting related issues that we wrote about. Inventory restocking and whether there may have been double ordering and there could be some issues there, and you'll have demand falling at the same time that inventories get bloated. And we walked through our explanation of why we don't really think that that's likely to be the case. We note that in 2022, if you look at the various categories of GDP, consumption, investment, residential investment, so non-residential investment and residential investment, net exports, inventories, all those things are likely to be positive. The only impulse that's likely to be negative is the one that means the least for corporate earnings. That's government spending. So we'll take that mix any day. So we still are pretty optimistic about the growth outlook. Moving on to the third tailwind in the inflation and reflation theme. As we've written, goods inflation surged. We fully expected that. We thought that the seeds were already sown for that before we even got to the pandemic. Next year, we're going to have something of a mix shift back to services inflation. But as we've been talking about even on CNBC a week ago, we think that policymakers are going to wake up and find that all this policy impulse is going to make service sector inflation worse. Now, the collapse of the Build Back Better plan, if it has indeed collapsed, will take some of the edge off of that. But nonetheless, we do fully expect education, healthcare, inflation to go back to longer term trend, and housing, it's baked in the cake already. And housing inflation is going to be much stronger than it was in the prior cycle. Services sector inflation is already above last cycle's trend. So we think it'll be quite robust. Moving on to policy, one of the things we wanted to go back and just remind everyone about is when the American Recovery Plan was passed, when the Democrats took those two runoff elections in Georgia, that was a shocker. And that 1.9 trillion was not expected. It was the first time in our career where we remember the Treasury market really resetting to absorb supply. Remember, 30-year real rates or TIPS yields moved some 60 basis points over the course of 3 weeks or so to absorb that supply. That was, to us, a real sign that the U.S. could very well find themselves at their borrowing capacity limit, where if they continued down the profligate path that they were on, rates might have finally started to go as a consequence of all this excess supply. But it does look like the political process, at least for now, has slowed that dynamic. The Fed had their hawkish pivot at mid-year. We called for a 10 to 12% correction. We didn't get a 10 to 12% correction, but we did get corrections in the sectors that we suggested taking risk off the table in: small caps, materials, industrials. Those sectors did pull back. So we didn't get as big a correction as we thought we were going to get, but we did get a bit of a risk-off episode in early fall. We'll see how that goes in the first half of the year. As we've written, we think liquidity is going to be much tighter, and we still think the Fed is way behind the curve. When you look at their summary of economic projections, they're hoping, or they expect, that they can get the real interest rate, that is their policy rate less the inflation rate, to zero by the end of the forecast period in 2024. To us, that just seems crazy. And we don't think that that's the operating environment we're going to be in next cycle. We think that they're going to have to go take that real rate back into positive territory, and that the so-called R-star, or neutral rate of interest, is headed significantly higher in the 2020s. So on the markets, we wrote that stocks are rich, but bonds are richer, and noted that we had something like a 34% increase in earnings last year. If you look at top-down strategists change over the course of the year, we think what most strategists got wrong was not understanding what reflation would mean in terms of operating leverage. Some got it right. Many others got it wrong. We generally were on the right side of that argument, arguing, because of our 60s analog and our work, this idea that the marginal cost versus marginal revenue argument would not supersede operating leverage from having stronger sales, having some pricing power, having the majority of your costs being fixed, at least across the whole index, and that would drive earnings significantly higher than most expected. And that's the basis for us thinking we're going to get 15%, not the 9% that consensus expects for 2022 as well. So the equity risk premium actually went up last year by some 50, 55 basis points or so. It's above its long-term mean. So stocks are actually on the cheaper side relative to bonds of where they've been historically. But of course, we think that the bond market is, the 39-year bond bull market is dead. That's something we wrote about a full year ago, and that bond yields are going to adjust significantly higher. So we will get valuation compression in 2022 is our expectation. So from an investing theme perspective, we stuck with reflation throughout the year. Other than that one call to reduce risk, we're sticking with reflation in 2022 as well. We do think that that's the regime that we're in. As we've written, though, hopefully we won't skip straight to the 70s. We will have a period where inflation settles in under 4%. That would be good news for equity holders, not so good news for bond holders, but still a pretty fertile investing environment. That's it for us. We'll try and get out a brief note this week. It's not clear we'll get a podcast over the Christmas weekend. Chances are we won't, but we'll get something else out by the end of the year. Certainly, if anything of consequence comes up, you could look for a written note for us for sure. We hope everyone has a great holiday. We hope we were helpful to your investment process this year. And if you're not a subscriber, we'd love you to consider becoming one. Barry Knapp, Ironsides Macro. Thank you.